Over the last few years, India's startup ecosystem has seen the rise of a new class of investor, the family office. These ultra-high net worth families, flush with capital, were used to investing in equities and debt and, of course, real estate. But over the last decade or so, India's startup boom has meant that these investors are also ready for a piece of this new asset class. From Ratan Tata to Infosys founders N.R. Narayanamurthy and Kris Gopalakrishnan, from Azim Premji to GVK Reddy and TVS Group, from entrepreneur investors like Sachin and Binny Bansal, Vijay Shekhar Sharma, and celebrities like Deepika Padukone, Virat Kohli and MS Dhoni. This group of well-stocked investors is now using their wealth to further the cause of the India startup story. Now, according to an Edelweiss and Camden Family Connect report, in 2018, India was home to 1.5 lakh high net worth families with a cumulative net worth of $2 trillion. This number is expected to rise to 4 lakh with a net worth of $5 trillion by 2025. However, the family office space is still quite nascent in India. As of 2018, there were only 45 formal family office structures in India compared to an estimated 5,300 single family offices worldwide. Having said that, the lack of transparency and information asymmetry in the private market does not make investing easy. While traditionally this group prefers to take the private equity and the LP route to invest, recently we have had a slew of UHNIs investing directly into startups. But the COVID-19 crisis has changed that, and it will be no different for India's high net worth investors. Hello and welcome to Young Turks, India's longest running show on startups and entrepreneurship. I'm Shereen Bhan. Joining me now to talk about the future for family offices in India and what they make of the startup story, a very special set of pandas. Gopal Srinivasan of TVS Capital Funds, Rahul Chandra of Arkam Ventures, Ganesh of Prayog Advisors, that is the family office of Kris Gopalakrishnan, Arihant Patni of the Patni family office, and Nimesh Kampani of LetsVenture Plus. Gentlemen, welcome to the show. Many thanks for joining us. Mr. Srinivasan, let me start by asking you, and we just read out some of those numbers there, and while this has started to pick up momentum, it's still nowhere close to the global trend. But has COVID and the crisis that we're currently in the midst of dulled the risk appetite even further, or do you believe that we will see more investors from family offices come forward?
Shereen, thank you for having me. I think the perspective I'd like to bring very quickly is that in India, about 40 to 50,000 crores of money are channeled into alternate investment funds, PE funds every year, somewhere in that range. And we must remember that 70% of the liquid wealth in this country is as available for. So, in that context, the same report that you referred to also says that families are 12% of their wealth to venture capital and private equity, 4% for direct investments. So I think India is really quite active, and if anything, the COVID crisis made people reevaluate what they should be doing. And I suspect that the long-term asset class will be one that they will look at least from our early indications. We have 50% of our money from family offices roughly at TVS Capital, third fund. We really think that I don't think they will immediately make any change. Right now, people are all moving. But I think India is quite active. And
Okay, we seem to be having some audio issues on the program. We'll try and sort that out in just a second. But Mr. Srinivasan, you spoke about the fact that you've got about 50% of the money coming into your funds from family offices. I just wanted to pick up from you. You're sitting on quite a bit of dry powder at this point in time. In terms of fund deployment, what's the outlook? And specifically, how are you looking at the current challenges as an opportunity? And where would you like to invest?
Shereen?
Yeah.
Yes, can you hear me?
Seem to have muted.
Mr. Srinivasan, can you hear me? Okay, I'll get back to him in just a second. Let me go across to Rahul Chandra. Rahul, you're the relatively newer kid on the block, so to speak. But, in light of the experience that you had at Helion and what you're hoping to do now here at Arkam, take me through what the appetite looks like currently and how are you looking at the current situation? Rahul, is my voice getting through to you? You're watching Young Turks, and we're talking about the future of family offices here in India. Let me go across to Rahul now of Arkam Ventures. Rahul, commitments of about 325 crore rupees for your 700 crore rupee fund. You've got HNIs like Binny Bansal, Vijay Shekhar Sharma, Rajesh Magao of Make My Trip, Sanjeev Bikhchandani of Naukri, Mikan Maheshwari, and others. What's the situation looking like at this point in time? What do you feel confident of? What are you going to be watching out for?
I'm assuming this is related to the VC investment environment, Sreen, or is it towards?
Yes.
So we closed this fund in March. So we announced it this week, and since March we've been in a way very fortunate in a very unfortunate time to be looking at investment opportunities which are either there is clarity that the COVID impact is going to be minimal or extremely high. There is also clarity of the business model. There is widespread adoption of practices which are far more capital efficient than they were before. So overall, I think we are seeing a great set of sturdy startups and resilient founders who are giving us an opportunity to put together a portfolio which will stand the test of all kinds of external forces and events like COVID. I think nothing can be worse than this. So it's great to actually look at a broadside impact happening and the startup ecosystem still being able to withstand that kind of impact. So we are very glad also that we are sitting on dry powder and we have a checkbook ready at this point. So we don't have to carry forward the challenges that other portfolios are going through. So in all, we consider ourselves to be quite fortunate at this point.
Yes, fortunate in an unfortunate time, as you rightly put it. But Rahul, let me just ask you about, you said that you've got enough dry powder that you're sitting on and you are ready to write out checks. Now, what are you going to be looking at? And you've got this sort of middle India theme that you're going to be focusing on. And that seems to be the theme that a lot of others are focusing on as well. I mean, I go back to my conversation with Sandeep Naik at General Atlantic, and the Bharat theme is the big focus even for someone like him at GA. So what's the investment bet that you're going to be making?
So Middle India has been ignored by VCs for the longest time, Shereen, because it's a market that most of us were not familiar with. We were not seeing it on a day-to-day basis. But the past successes in this market, despite the fact that technology adoption was minimal, both in terms of exitability, companies that went out and listed like Spandana, Equitas, micro housing as a sector. And we're now beginning to see this combination of technology solving problems for Middle India. In the past, we've also run into companies which ran into the scalability wall because the markets they were targeting were limited by just the size of people who are in the upper middle class, people who we know and can identify with. But Middle India was almost behind a barrier of technology adoption. With Geo and with the infrastructure that has been put together by public utility like Aadhaar, that has given us a very good access to a fantastic large market whose needs are completely unmet. So we are also being able to double up on what is considered to be essential services in these times, things like agri and healthcare, and we are seeing adoption. So some of the companies that we are evaluating at this point, they have strong tailwinds of just regulatory barriers coming off and regulatory support, as well as supply chain inefficiencies getting cleared out for them. So we are very excited about how these companies could grow in these times despite the challenges. And again, every company that we are looking to invest in closely is projecting a year which is a high growth year despite the challenges in the environment.
Okay, that's good to hear. Nimesh, let me come across to you now and ask you about what the outlook looks like when it comes to being able to unlock domestic pools of capital. As we pointed out, the Edelweiss and Camden Family Connect report from 2018 certainly seems to suggest that there is a lot of appetite and interest. But what do you believe are the challenges that hold this investment back? And at LetsVenture, through LetsVenture Plus, how do you intend to bridge that?
Thanks, Shereen, for having me on the show. So basically, to answer your question, I think the biggest problem that we have seen in India for family office is the access to the right deals. And that also, the aim at LV Plus is to organize this, to democratize this, and get access to family offices, which erstwhile was not available. And I'll tell you how we are doing that. So if you see global VCs and a lot of domestic VCs now, have raised a lot of capital and are coming down the curve in terms of the stage of the companies, right? They're going earlier and earlier. With that, I think the opportunities for family offices have been coming down. Our aim is to participate in that and try and bring to our 100 plus family offices that we have on board, unique opportunities which would include bridge rounds, which would include some amount of liquidations that is happening, some amount of allocation in exclusive funds that are, global funds. So I think get to be the right private markets partner for this entire family offices spectrum, for whom deal access, which was earlier available only to privileged few, and at the same time get in transparency and basically on the pillars of trust. So that's what we are looking at.
Okay, so you believe that if you are able to provide enough of a connect and solve the problem of the information asymmetry and formalize this market, so to speak, that we're likely to see a significant more of domestic capital coming in towards the startup ecosystem?
Yes, and see, two other things have happened. One is the younger generation, which is in the 35 to 45 age group, has now come into play in a lot of the family offices where they come with global exposures, they come with global degrees, they've seen a lot of things, so they have higher risk appetite. And at the same time, they have a longer gestation period.
Okay.
And also what the families on board, right? Earlier being a part of the VC ecosystem. So I think this two set helps a lot in terms of they wanting to participate directly into deals. They don't not only want to be a financial investor, but you are seeing interest coming in terms of being a mentor, being strategic. There are quite a few guys who have set up their own accelerators or incubators on the side. So plus basically they try and open up networks, they try and open up their expertise in the particular segment they are in, technology. And I think this is something which is very good for our ecosystem in India, because this is something which will help the young entrepreneurs to build scale.
Yes, and speaking of the next generation, the point that Nimesh was making, that we're seeing a lot of interest coming in from Gen Next, taking corporate India's legacy forward and moving it into the startup ecosystem. Joining us is Arihant Patni, the MD of the Patni Family Office. Arihant, how are you reading the signs at this point in time? What is the strategy within your family office? How are you going about deploying funds?
So first of all, thank you, Shereen, for having me on the show. I think first and foremost, as you said in the beginning of this show, the evolution of family offices over the past few years has been dramatic. And a lot of the family offices have been created by recent IPOs or sales of tech companies and other asset sales. So the DNA of entrepreneurship is very much still existing, very vibrant within these family offices, with the older generation, with the younger generation, and so on and so forth. So the fact that venture as an asset class or young entrepreneurs building new exciting businesses out there is definitely a very attractive proposition. And as was discussed earlier, what's happened is that there is a fantastic ecosystem that has now been built over the past few years of new age startups coming up, of new capital that's supporting them, mentors like Binny Bansal, as you mentioned, and other stalwarts that are actually encouraging them. And it allows family offices like ours to put long-term patient capital, capital which is not necessarily bound by fund life and by other constraints, and also participate in areas that are strategic to us, may it be consumer, may it be healthcare or IT for folks such as myself and B2B businesses. So it becomes a very, very interesting way of sort of reliving the journey of having been in a family business and having maybe exited a family business, but living vicariously through all of the young entrepreneurs that are out there.
Yes. How vicariously do you intend to live, Arihant? I mean, what's the sort of vision that you have in terms of the kinds of investments that you're going to make? How many do you intend to make? And to Nimesh's point on not just putting in capital, but also sort of playing mentor, getting involved perhaps strategically, is that part of your plan as well?
Absolutely. I think all of that is true. To answer your first question, again, as a family office, it's an open charter. So you could actually invest in anything. And I have invested in many interesting plays just from a passion standpoint, just because I think I believe in the entrepreneurs and I believe that they can break through and do something that's new and interesting. At the same time, you do want to pull back to your strengths, right? And the hardest part is, how do you say no to some of these things? Because everything's an opportunity, and you're not, you don't want to sort of miss out on something that's really exciting. To come back to your point about how we help these companies, we invest alongside these founders. We've dealt with the sways of building a business. So we take active board roles, where provide them with strategic advice, with customer access, with networks, with basically whatever they need. So we're just a phone call away. I've invested in IT services companies, analytics companies, big data companies, folks that need, especially that can leverage our cross-border, expertise with the US and other parts of the world, and help them get to the next level.
Yeah. Okay, just a phone call away. We're not going to be handing out your phone number on this program, lest you're inundated with calls. But let me bring in K. Ganesh into the conversation as well, the president of Prayog Advisors, the family office of Kris Gopalakrishnan. Ganesh, many thanks for joining us. It's been a difficult March and April for you. You're seeing the portfolio being churned at this point in time. You expect that process to continue for the next 3 to 4 months. In light of what you're seeing happen with the current set of challenges on account of COVID, what is the investment strategy likely to be as you move ahead?
Yeah, thanks, Shereen. So COVID has had impact. Our portfolios had come down by almost 15-20%, both on the equity and the debt side. We had issues around some credit risk funds, though we were not too much impacted because we are a conservative family office. However, we completely believe that we will come out of these woods, and in the next 12 to 18 months, it's going to be positive. And in the longer term, we are completely bullish about the Indian economy and the demographics which India offers. So all our investments are long-term patient capital, which hopefully will give us the right returns over the longer period of time. We are, Kris is obviously very passionate about startups and supporting first-generation entrepreneurs, which we have been doing through the Axilor, which is a startup accelerator company. We invest with funds across all stages, starting from seed stage to pre-IPO funds. And we are very positive that this also provides opportunities for models which have actually withstood this challenge, the COVID challenge, and who have also managed their costs very well. So both on the tech side, on the healthcare side, which are cutting edge and which can be easily scaled up, those are the models which we are looking at.
You caveated that nicely. You're a conservative investor, Ganesh. So given the fact that you anticipate the next 12 to 18 months to be challenging and difficult, does that make you even more conservative today?
I think the lack of data is where the issue is, right? We don't have much data coming in for the next at least 2-3 months. We'll have to wait before companies provide their Q1 results. So we will have to be careful about investing. However, we are closely working with all our investments, mostly the startup side. We are very we are close to the ground, understanding the challenges, understanding what they're doing about it. So we'll back them as long as they have a credible plan to bounce back.
Okay, Mr. Srinivasan, let me ask you, because your report is titled "Bright Opportunities Amidst the Gloom." So, where are these opportunities that you're being able to spot at this point in time? What is going to be the change in the investment strategy as we move forward and you start to deploy more cash?
Shereen, to be very, very candid, in the private space in India, there have been many, many great companies and great founders, but never at a good price. India has always been overpriced, whether a family office was investing or a fund was investing. Maybe funds a little bit more pushy. Some family offices are amazing. So what we have right now, especially in sectors that have felt the cataclysmic thunder of the COVID fall, like lending, for example, are really, really good businesses. Managements we know and trust, but honestly, their pricing is down dramatically. Some of it could be through the public market, some of it could be through the private market purely. I believe September, October is when, in some sense, the bubble will burst, or bubble of the past, where people are still in denial of what is happening. And I think you will see some of these great companies, because they need to grow their businesses, actually raise money at prices that are substantially lower, which we are calling fair prices. So it's better to select sectors where there is a crossing of the chasm involved. That's where you're going to see them. But if you're crossing the chasm, you better be good enough to be a Sherpa. So you only want to do it in areas where you are confident with past record that you can be a Sherpa. In our case, it's lending. That's one thing we understand. For the last 10 years, we've done very well for our investors on lending. So we will stay only there. The rest of it, as Rahul also referred to, shortage of capital. So you are finding good companies at some small discount, typically expressed by the instrument of which you use, which discovers the price into the future. And of course, there is a COVID positive segment, which is, ed tech is like the poster child COVID positive, and there are probably few others. Where I think the pricing may be at a premium. So we are in the crossing the chasm. We've already made one investment. We probably make a couple more, but we will wait till September, because there is right now life in slow motion. And therefore, nobody is going to do anything in a hurry. But you will see what they will do in September, October. They will certainly review who they invest with and how they invest in family offices.
Okay, so since you're talking about this denial period, you expect that denial period to perhaps come to some sort of a closure closer to September or October. You talked about a substantial change in what you believe will be a fair value. How deep are the cuts likely to be, Mr. Srinivasan?
I think it very much depends, Shereen, on our own risk appetite. If you want to go in this crossing the chasm strategy, like in lending, I think it could be as high as 50%, because you really don't know whose book you're underwriting, what the book looks like. But if you're going into what I call the value segment, which is just shortage of capital, it could be 10-15%, typically translating itself as the instrument that discovers price in, let's say, April 21 or maybe even 22. So that you're really assuming a discount. You're more than that, you're anchoring for safety, saying if you do this, then this will be the price. So I would say, for example, if I were a fund which is very good at travel and tourism, there must be tons of opportunities. Look at the pricing of PVR or Inox Leisure or chalet hotels today morning. So there's plenty of opportunity, but you must be a Sherpa to climb Everest.
Yes, you must be a Sherpa to climb Everest or cross the chasm, as Mr. Srinivasan has just explained to us. So let me ask each one of you on what you make of that theory. Rahul, let me start by asking you, what do you expect in terms of pricing going forward, at least over the next few months? Do you agree with what you just heard there from Mr. Srinivasan?
I think Gopal was referring also to the debt portfolios. In our case,
yes.
Early stage up to Series B is very different from post B rounds. I think C onwards are under a lot more pressure than they were before. I think access to check sizes above $25 million is really scarce right now. And obviously those companies are also on a very high burn rate. So the situation is actually quite grim, some of those. Up to Series B, what we are finding, which is really our scope, A's and B's, we are finding two kinds of opportunities. One is the A, which is no longer being chased by 4 investors. It's probably being chased by 2 investors, right? So there's the upbid, which would normally result in the highest bid winning for an early round, which was completely irrational. It was more of a I definitely want this deal in my portfolio type of bid. That has, the pressure has gone off that. So, I think, again, within the realms of what is realistic, rational, we are getting into the A's without too much competitive pressure. And the B's, we are seeing something happening in between. We're finding A plus or pre-B rounds where the raises are lower, the valuations are certainly a compromise between what the investors are willing to pay and the external investors are willing to agree to. There is something that's happening where it is not fully priced. I would say in any other market, these deals would be 30-40% more than what they're happening today. The B's, that is.
Okay. Nimesh, just to take what Rahul has told us, and I think that's interesting, taking the competitive pressure off could perhaps also mean that we could see saner valuations or fairer valuations. But to the point about access to check sizes, access to capital, what are you picking up on at this point in time?
I think so. I completely agree with what Gopal and Rahul had to say, is that the capital is dried up, people are postponing, funds are postponing investing into many of these startups. But at the same time, what we are seeing is that what Gopal mentioned, that there are COVID positive companies, the sectors like EdTech, MedTech, digital online gaming.
It gives COVID positive a whole other meaning. It gives COVID positive a whole other meaning.
That is what is being used nowadays in the startup world. So what we are seeing is that we basically are piggybacking on all of these VCs that would have committed or would be committing in a short period of time. So we are seeing a lot of bridge rounds happening. We are getting a lot of interest both from the investor side and from the startup side to raise capital on these. And we actually are doing some of these as we go forward. I think we are in the process of doing each of these in one company, each of these segments as we speak, which will be primarily dependent on it's structured in a way that it's dependent on how the next institutional round happens. So, the family offices have the comfort to getting in early. They get a value, right? Because they come early, they get a value there. And the startups are getting the money for cash reserve, right, as they speak. So at least they're putting in money for the next 10 months. And that's the sweet spot we are in right now. So that's actually pretty interesting as we speak.
Okay. Arihant, let me ask you about the sweet spot, if any, that you find yourself in, and what is the investment strategy going to be, at least in the near term, given the kind of volatile times that we're living in?
Shereen, I love this time, right? I love this space, in the markets where you can actually sit down and have real conversations with entrepreneurs and talk about real business, where they're not swayed away by comparable valuations that their peers may have gotten by other funds or by companies in China or the US and so on and so forth. So that reality check is just great to see. Of course, it's horrible that it's come under such duress, and it's not a great situation to be in. But I think most founders that we're working with recognize that this is something that they have to address real time. They have to take measures and they have to survive through, and we're helping them do that, right? So I'm in EdTech, health tech, financial services. We have a company called Waterfield Advisors that we've partnered with that does wealth advisory that's doing really well in times like this. As I mentioned, an analytics services company. Going forward, I think it is time to be cautious. I think it's also about really drilling down with these companies in terms of what is the value that they're providing, what is the value that their product is providing to enterprises or to consumers for that matter. We have a company called Bombay Shirt Company that we've invested in a while back, because this is what differentiates the good and the bad, or the weak and the strong, right? And it's great to have a look at what are you really doing, what do you stand for? And I think that if we can help them stand for that, then we've got a winner. And that's what I want to put money in. It could be anything, right? I just I need that conviction from the team and that conviction with the idea.
Ganesh, speaking of conviction, and I know that science and has been a big area of focus for Kris specifically. What is going to be the thematic bets that you're willing to take at this point in time?
Yeah. So as you mentioned, right, Kris is quite passionate about research and innovation, which we have very less amount being spent by both the government and the private in India. And we are working very closely with the Indian Institute of Science, IIT Madras, and other institutions across India to fund research and development. Kris himself has committed over 350 crores for research across these institutions, as well as trying to get postdoctoral collaborations across world universities. So we are very, very positive about these research and innovation coming through in the next decade. And even in the same category, same area theme, healthcare as well as digital, and where niche areas where people are making significant progress, creating IP, are startups which we are backing. Healthcare, specifically aging, healthy aging is a theme under which we are investing. Early stage, but we are very positive about it.
Okay, that's good to hear, gentlemen. We wish you all the very best of luck, and we hope that you continue to steer your individual funds and family offices to better opportunities, safer opportunities as well. Rahul, Mr. Srinivasan, Arihant, Nimesh, and Ganesh, thanks very much for joining us on this special edition of Young Turks. It's also a special day for us here on the show. We've turned 18 on exactly this day. It is the world's longest running show on startups and entrepreneurship. So from all of us here on the team, goodbye. Many thanks for watching.